All right, let's jump right in. Welcome to This Explainer, where we're going to tackle a journey pretty much all of us will take at some point, and that is buying a car. Now, finding the perfect ride, that's usually the fun part. But financing it? Honestly, that can feel like stepping into a complete labyrinth of dealership lending traps, hidden fees, and just really confusing jargon. But today, we're totally transforming that experience. Think of this as your hero's journey to buying a car without the fear. We're going to arm you with the exact strategies and the legal rights you need to secure the absolute best deal and protect your wallet. Here's our roadmap for today. 1. Prep before you shop. 2. Direct versus dealership financing. 3. Navigating trade-ins and add-ons. 4. Closing the deal safely. And 5. Handling post-purchase problems. Let's get to it. Before we get too deep into the weeds, here is the big picture, 5-step process laid out by Experian. I really want you to notice where Visit Dealership is on this list. It's step 5. It's literally the absolute last thing you do. First, you budget, you check your credit, you shop around, and you get pre-approved. Preparation is basically your ultimate weapon against getting ripped off. If you nail those first 4 steps, step 5 is going to be a total breeze. All right, section 1, prep before you shop. Okay, this is huge. The biggest psychological trap in car buying is what we call the monthly payment illusion. When you're sitting at that desk, a dealer is almost definitely going to ask, "So what do you want your monthly payment to be?" It sounds super helpful, right? But it's actually really dangerous. A low monthly payment is super tempting, but it almost always requires a much longer loan term. We're talking like 72 or 84 months, and way higher interest rates. The result? Your overall cost just skyrockets. You know cars lose value quickly, so with a super long loan, you could easily end up owing way more than the car is even worth. You always want to focus on the total out-the-door cost first. So how do we get that total cost down? You need a good interest rate, and that starts right here. Several months before you even start shopping, go to annualcreditreport.com or call 1-877-322-8228 and grab a free copy of your credit report. Why? Well, because your credit history directly dictates your interest rate. Check the whole thing for errors. If you find inaccuracies, dispute them immediately so they can get wiped off before you ever apply for a loan. A slightly better credit score can save you hundreds, honestly, sometimes thousands of dollars. Now, the absolutely crucial point here is that you need to shop around for loans. But you might be wondering, wait, won't applying for a bunch of loans totally tank my credit score? Well, let's talk about the magic numbers, 14 to 45. When lenders pull your credit, it creates a hard inquiry, which normally docks your score a bit. But thanks to consumer protection rules, you actually have a 14 to 45-day window where all your auto loan inquiries are completely lumped together. They literally count as just one single inquiry. So please, don't let the fear of a tiny credit hit stop you from comparison shopping. It's totally fine. Moving right along to section 2, direct versus dealership financing. Let's weigh your 2 main routes here. Direct lending means you're going straight to a bank, a credit union, or a finance company. The massive benefit to this is getting pre-approved in advance. You know your annual percentage rate or your APR and exactly what you can spend before you ever step foot on the lot. Dealership financing, on the flip side, means the dealer is acting as a middleman. They're taking your info and blasting it out to various lenders. Now, they might offer some cool special manufacturer incentives, but keep this in mind. The dealer usually profits by marking up the interest rate they get from the bank before they turn around and offer it to you. Getting a direct pre-approval first gives you a really powerful benchmark that they have to beat. So your interest rate is determined by some pretty exact inputs: your credit score, your income, your debts, the specifics of the loan, your down payment, and the type of vehicle. But here is a wild fact straight from the Consumer Financial Protection Bureau. Lenders are not required to offer you the best rate they have available. I'll say that again because it's crazy. They do not have to give you the best deal. That right there is exactly why shopping around and negotiating is so essential. You literally have to ask them for a better rate. Which brings us to section 3, navigating trade-ins and add-ons. If you're bringing an old car to the table, preparation is absolutely key. First things first, research its value on NADA Guides, Edmunds, or Kelley Blue Book. But here is the ultimate insider tactic. Keep your trade-in a complete secret at first. I mean it. Negotiate the absolute best out-of-the-door price for your new car, completely separate from the trade-in. If you mention the trade-in right off the bat, a dealer can easily tweak the sales price of the new car to make up for giving you a supposedly generous offer on your old ride. You've got to keep those transactions separate. Now, a massive red flag to watch out for is this term right here, negative equity. Basically, this is when you still owe more money on your current car than it's actually worth in a trade-in. If a dealer smiles and offers to just roll that negative equity into your new car loan, be extremely, extremely careful. Doing that increases the total amount you're borrowing, it lengthens your financing agreement, and it totally inflates your monthly payment. You are essentially paying off two cars at the exact same time. Not fun. Okay, so the car price is settled. Next, you'll be offered the extras. Make no mistake about it, auto add-ons are absolutely not free. Things like gap policies, window etching, extended warranties, those are all financed right into your loan, which means they're costing you interest over the years. You have the total right to just say no. And more importantly, it is strictly against the law for a lender to deceptively tuck products like credit insurance into your loan without your clear knowledge and permission. If you don't want it, decline it. Simple as that. All right, Section 4, closing the deal safely. So you've made it to the finance manager's office. For most of us, walking into this room fills us with an existential dread usually reserved for root canals. Actually, scratch that. It's more like being called into the principal's office. But your magic weapon in this room is the Truth in Lending Act, or TILA. This is a federal law specifically designed to protect you. TILA requires lenders to hand you written disclosures that have all the vital details of your loan completely, 100% filled out before you sign a single thing. You can even insist on seeing these forms early so you aren't rushed, and you can totally take them home to compare with your other offers. When you finally get that disclosure, check it against this exact TILA checklist. First, verify the APR. That's your interest rate plus the fees, so it expresses the true yearly cost of borrowing. Check the finance charges, which is the total interest you're going to pay over the life of the loan. Verify the amount financed, the total of payments, and finally, the total sale price. And remember, the total sale price includes your down payment. All this paperwork must match the exact out-the-door price you just spent all that time negotiating. If those numbers don't match up, stop right there. I really want to highlight this direct, punchy advice straight from our sources. It says, if the dealer asks you to sign a blank or partially filled-in form, you should decline. Never, ever assume a blank line is just going to be filled in later with the verbal agreement you just made. If you don't understand an aspect of the loan, or if you feel rushed or pressured, remember that you hold the ultimate power in this situation, the power to simply stand up and walk away. Finally, Section 5, handling post-purchase problems. Look, if you hit a roadblock after you drive off the lot, you don't have to fight these battles alone. If you're dealing with deceptive dealers or shady ads, you want to contact your state consumer protection agency or the Federal Trade Commission. Having trouble with your auto loan or weird payment practices? File a complaint with the Consumer Financial Protection Bureau. They will literally forward your complaint directly to the company and work to get you a real response. Warranty issues go straight to the state's attorney general, and safety defects go to the National Highway Traffic Safety Administration. This breakdown right here just cuts right through all that bureaucratic maze. So from separating your trade-in negotiations to using that 14 to 45-day credit window to wielding the Truth in Lending Act to your total advantage, you now have the exact blueprint to completely bypass those dealership financial traps. Really, the only thing left to ask is, are you ready to take control of the negotiation desk and drive away with absolute financial confidence? Thank you so much for joining me on this explainer. Go ahead and use these tools to secure your absolute best deal.